Well, hello there. We have CPI, which came out today. We're going to talk about that in this video. We also have big bank earnings coming up, and we're going to talk about what that might mean for the market and maybe even the economy moving forward from there. There's also PPI on Wednesday, January 18th, that gets released. The personal income and outlays on January the 27th, the FOMC meeting on January the 31st through February 1st. This could be sort of a turbulent month. We'll talk about what it means for the tomorrow, the following week for investing, which I believe markets are closed on Monday in observance of Dr. Martin Luther King Jr.'s birthday. So that means that markets pick up back again on Tuesday. January is just going to be a wild ride all the way up through February, and then we'll really see where the direction takes us from there. So with that said, I'm Dr. Stock, Doctor of Education. Let's get on to the content. So for the CPI today, I just want to bring up my projections here just for a moment, because we had negative 0.1% month over month, which means for December, the actual value that came in seasonally adjusted was 298.112, which comes out to a year over year measure of 6.4. And again, that's seasonally adjusted. And it's important that I point that out because there is a discrepancy between the number that I have here, because it is seasonally adjusted, and the number that's on the CPI report itself when we take a look at it, which says 6.5% year over year, but it is marked that theirs is unadjusted. So I will handle that. I will take care of that discrepancy so it matches more what BLS has when I do the January CPI for when February comes out. I feel like that's Valentine's Day. I have to look and see the specific date. I think I have the calendar up. If not, it's one that I'm sure that I'll get back to. I do have some other things I want to take care of first. So this is all items for CPI. This is the headline number 6.4 for the negative 0.1% month over month. And while that's an excellent read, if more of it, that negative 0.1% were attributed to core CPI, today would have been a much greener day. I think that it was sort of muted because of core CPI. So let's switch over to that one. So going less food and energy, we still had 0.3% month over month, which it's not a bad number. It's just kind of that's what it is. And that's a nice feeling, I think, coming out of the pandemic and going through all the different volatility to see a normal inflation number come out. When I say normal, it's because of the analysis. If you watch my other videos, you'll see that it's, I believe for core, that's both the median and the mean value is 0.3% month over month. And so for December, I have it filled in 300.974, again, seasonally adjusted, although it didn't turn out to appear as a discrepancy for this one. But although, like I said, I will fix that when I do the one for January. I will use unadjusted measures for that, so that way for the year over year measures, we don't end up with any other discrepancies. So here that I have in the highlights, and I meant to mention this on the year over year as well, I switched over to having January highlighted so we can see how these different measurements, which most likely, it seems like core doesn't move very quickly on us. I should say that it seems to be slowing down with just how volatile it is. We're not getting as much change. So we could be close to this 0.3% for the next month coming up. And I'll do my analysis on that and I'll get that out to you guys. But if you take a look, if we come in 0.1, 0.2, 0.3, which are all very typical values for core CPI, we could see headline numbers for core CPI next month of 5.2, 5.3, 5.4%. So we'll see what news comes out in that time. Part of that is the PCE index gets reported on January the 27th, and I have a whole workup on that I'll be sharing with you guys. I do want to talk about some other things first and bring like the PPI, which comes out on Wednesday, January the 18th. I think that's something a little bit more recent, something that's coming up a little bit sooner, that I want to make sure that I go chronologically so that way we don't miss anything along the way. There you go, the Bureau of Labor Statistics. For all items for CPI, there's the headline number of 6.5, and here, let me zoom in some more so you can see it better. See unadjusted 12 months. I had the seasonally adjusted, and that's why mine says 6.4, and theirs says 6.5. Slight difference. Really, it's this month over month measure that we want to pay attention to anyway, and if you look across the months leading up to this, I might have to zoom out a little bit to make it work. There we go. September and October came a little bit hot for us. The market didn't like it very well. And we had all that Fed tightening. And, with these lower measures from November going to 0.1, December going to negative 0.1, and also core CPI going, that one, by the way, I believe is, let me zoom out. It's this one right here. I'll zoom across so you can see all items less food and energy. Track this blue bar going across. There's your 0.3% and then 5.7% year over year on an unadjusted basis. Like I said, it was an okay CPI. You know, the headline number for month over month for all items could be a negative 0.1 because we had a steep drop right here of negative 4.5 in energy, which was weighted pretty significantly. You know, that was a nice drop. Like I said, core attributing more of that would have given us a little bit more green in the markets, but it wasn't red in the markets. You know, a little bit less volatility could do us some good. I did mention that the PPI is coming out on the 18th. This is the one from November that we're looking at. And so when we go to total final demand for PPI, I'll zoom in here so you can just check out some of these months that we have. So November at let me go to 2022. There we go. So you can see the higher numbers, 1.2, 1.1, 1.7, 0.5, 0.8, 0.9, and then negative 0.4. We get a steep drop coming off of June there. And this would be the more volatile measure that we have for PPI. If we go over to the next column, we'll have a little bit less volatility, and you'll see that as well. But it is nice that we're getting in these lower numbers, and we started to stabilize September through November. So we'll see if more of that stabilization happens. I will do a full video on PPI coming up tomorrow or early this weekend. Those are the 2 times. There's a lot of data to crunch. There's a lot of stuff to build, and I want to make sure that I do it well and do it right the first time for everyone. So this column right here is final demand, less food, energy, and trade. And when you take all that stuff out, you get some fairly consistent numbers. You know, they're ones that we can count on, and we'll talk about in the video on it how good or how bad that is. We do want to keep these numbers low, and we want to stick with that downtrend that we're currently experiencing. Go all the way across. Here we go. Change in final demand on a 12-month unadjusted basis. There we go. And again, check out those numbers. High 6s, 7, more high 6s, down to high 5s, and then finally we broke down below 5. So keep that downtrend going. These are all things that we want for that Fed too. We want them to either use the word pause or quantitative easing already. Give us a little bit more dovish signaling. I think right now there's like a 96.2% chance of a 25 basis point hike at the FOMC meeting, which takes place January 31st and February 1st, and February 1st is when we will get that result. So we will watch for that to happen. We expect it to happen. The March meeting right now, I think it's still most likely the 25 basis point hike is the consensus, and we'll see as these other numbers come out leading us up. We have a lot of big things coming up between now and then that it's not out of the question that we get a pause for March. But then again, it's also not out of the question that we get a 50 basis point hike for March, but still the most likely thing is that we would also see another 25 basis point hike in March when the FOMC meets again. So I also wanted to talk about the bank stocks that the bank earnings, JP Morgan, Bank of America, Wells Fargo, Goldman Sachs. Goldman Sachs isn't until next week, but we have a lot of big banks reporting earnings. It's their forward look that we want. We want their outlook for 2023 concerning the economy. We want to know if they see recession in sight. You know, how likely is it that we go into recession? Because recession, bad for the economy, bad for the bank stocks, bad for people who want to have a job instead of getting laid off, you know, when they're trying to provide for their families. So if the banks don't see recession coming, if they still see strong consumers, if they still see GDP growth, a really healthy economy, you know, it's kind of tough because, you know, then we still run into more quantitative tightening. So the Fed's trying to smush us down, and we're just trying to exist and move on, and we'll like I said, we'll see what the bank stocks say. So if the banks see bad things for the economy, if they see a big recession coming, if they toss out those fears, the market's going to respond, and a lot of the green that we saw could possibly get wiped out. And you know, we've seen a lot of green lately. It's not been enough to really move us up into a reversal territory to take this bear market and turn it into a bull market. I think that we saw another bear market rally, and you know, I hope that for a lot of our sakes who are bullish, that we want, you know, long term, or that we go long on our investments and long on our trades, that we want to see the market go up. I did hedge against any downside risk by investing a small amount into an inverse triple leveraged ETF, SQQQ. We'll see if I happen to, if my suspicion is right that tomorrow's a big red day, well, then I'll take my money and run, and then I have that extra money from that to continue to look for investment options moving forward and replanning based on what we see happening from there. I don't know that we've hit that final point of capitulation. I think there still is potential to drop significantly from where we're at right now in the overall markets and experience just a little bit more pain for this next quarter or two. But I think that 2023 has a brighter future in it than a lot of what we might be seeing happening now. I know that we're all wanting to get to that point where the Fed says pause, and that we want to hear the word recession happen so we can actually just finally get over it and get through it. I think that certainty would do us a lot of good. I think that there's one more big moment coming up around the bend, where we hit peak fear, and I think from that point we're going to see massive capitulation, and then from there we're going to start that next bull market cycle. So I could be wrong. Those are my thoughts. Those are my feelings. I don't have any total hard evidence of any of that, and I wish I did, because if I did, I would most definitely take advantage of it. Speaking of taking advantage, I feel like at this point I'm taking advantage of your time. So thank you guys for sticking around this long. I really appreciate it. It's really great to be back on YouTube, and I look forward to just developing more of what I have, more services that I have to offer you guys, and bring you as high quality information as I can every time. I'm Dr. Stock, Doctor of Education. See you in the next video.